we don't have to go super in depth about how to do the whole loan. I think it's kind of cool to just point out what can be done,
Oh, perfect.
how much different the cash position is than even a
Yeah.
normal government deal. It can
Yeah.
potentially be a lot less.
Yeah.
Um,
And the reason I ask is because, length of career for me and Michael, and when we left Atlantic Union, we kind of left behind, in my opinion, a product that could fit almost any need that we could morph and make happen when someone said, "Hey, I want to build a home."
mhm.
Yeah.
Like my general opinion right now is that when I had two of these blow up in my face in October, November, our product is very compromised, at least the one I attempted. So
What'd you
obviously,
try to do?
Yeah. Which one?
uh, just the conventional through, where we had to get all the stuff through Land Gorilla,
Mm.
and the contract, like the instead of a cost plus, like, the just all the stuff. I mean, I kind of blocked it out of my memory. One of them, it took so long, they found another lender, and the other one, because of the calculation, like we couldn't make the numbers work, and the client didn't have the money, so they eventually just stalled.
Hmm.
Um, and the process was much, like, there was a lot of delay.
Yeah.
Could have been my fault. Could have been, like, just our processing team, but it just, I mean, I just, it was not anything like what we were used to at all.
So I haven't dove really deep into the land gorilla conventional side.
Yeah.
It's definitely we plan to, but what I'm hearing from Jimmy Fitch is that they've got a number of these loans under their belt now, and the process is getting smoother. Morgan is working with a lot of builders now because once
Gotcha.
we close it, we're done with it, right? But Morgan's working with either NCF or Land Gorilla on draws and completion and obviously securing the final, note and all that kind of stuff. So they've got another really sharp processor that they're training into the front end of
Gotcha.
this. And
Yeah.
I think the thing that's maybe more appealing on these gubbies is just the guy Travis McKnight that runs NCF, National Capital Funding, and how much they do on these deals on the front end. I think it's a very different process than the conventional side.
Gotcha. So why don't you dive in? I mean, obviously, this is the only people that qualify for a VA construction loan would be people that have VA eligibility.
Yeah.
Right. And when
Start
we
there.
talk about these two, so when you talk about government, any of the governments go to NCF. They're all managed by them. So we can do USDA, FHA, and VA. They're all three are similar in thought process. So this is where they separate a little bit, is that um, there aren't interest-only payments due from the borrower during construction. All that gets rolled into the builder's bid, right? Um, and so you can roll in potentially all the closing costs as well. So when you're talking about LTV requirements and what lenders are available to actually do these loans, I think that's where it gets unique because, Travis and I spoke about the potential for networking with builders. There aren't a lot of mainstream lenders that are doing government CP, right? So when you have a program like VA that can go zero down up to 2.5 million, that's something that, if you go and meet with an established builder, they've got finance guys that they're working with. You're not going to replace them overnight, but can you help them with their business planning and take them from doing 25 deals a year to 30 deals a year with programs that aren't available because they're really not available. And same thing with FHA. You do 3.5% down and you look at the whole total acquisition cost between the build and the land, and now you're rolling the finance soft costs into the loan for the builder, right? You're rolling the interest only payments during build into the loan and potentially the closing costs. So there's great potential that your borrowers are only bringing 3.5% to the closing table.
Hmm.
And obviously the great variable in all that is the appraisal, right?
Mhm.
And their plan. But what I can show you guys is kind of, I think for me as an originator, what has been intimidating about talking about CP is one, the initial conversation, how much are you going to end up foot and mouth versus having enough substance to talk about with a client, right? Up
Hmm.
front. And then what's the process look like? Are you then on the hook for some impossible calculations that are never going to come together? Are you going to ruin a relationship with a realtor? So I think kind of knowing what the initial setup process looks like overhead, having access to the resources, and kind of knowing what to talk about with a new client would be a good place to start in the conversation. I'll throw up my screen kind of quickly here. I went ahead and started a shared drive today that I invited some people to, with government CP resources. Uh, if you guys want to give me a list after the meeting of anyone that's interested in it, I can add you to it. Keep in mind these forms and these shared drives are floating around in the company right now, and they change a lot. So everything government goes through NCF, and there's a training packet in here, right? And then there's a 2 hour long video, which is really, really good. That walks you through everything. Like if you watch that video, you'll be confident in the product and talking about it. But one of the things that gives you in that training packet is a link to like NCF's forms. So it's always good to check for updates. Like I had a couple of updates on here that I pulled that we just sent to one of our clients. It was good that I checked there. So just be careful. Like if you get an old processing share directory or a shared directory from somebody, and not everything's going to be as updated in there. But this stuff is as updated as possible. That's in this one right now. So when you look at a deal up front with for government, um, and you're talking to a client about it, obviously like the normal rules that we know, like no work can start, before the close and all that kind of stuff. You're kind of learning about their goal, right? Like, do they have a builder? Do they have plans and specs? Like, have they started looking at lots? What's their timeline look like? And so your question mark might be like, how do I initially qualify that person for CP? So I think if you get an all-in acquisition cost from them and they say, hey, it's a 50K lot and it's going to cost me 500K to build it, so now you're thinking 550, I would up that by about 12% for the pre-approval. Is a pretty good rule of thumb on these.
Hey, John,
Yeah.
one interlude. When I moved to Nashville in 2000,
Hmm.
I bought a house on the courthouse steps in foreclosure in 2001, and I renovated it. And I got a lady named Mary Benny Wilson from the Bank of Brentwood. And I drove out to her office because they said that she does renovation loans. And so
Hmm.
when I sat down with her, her accent was really thick, and I wrote out all the numbers. And she goes, "Well, you know what we're going to do? We're going to add 10% to this because everybody's always wrong." Now it's 12%. Everybody add 12% because it's
Yeah.
just wrong. I might even up it to 15%. But she said it with that accent, and I'll never forget that line. So sorry. One
No, you're
iteration.
good. And that's your best case. I think if you go ahead and add that 12%, now you're working, you can work your ratios and make sure that somebody can get pre-approved for it.
Sure.
But the process at that point's pretty simple from our stand. I mean, hopefully their answer is, yeah, I've got a builder in mind, because that's the biggest holdup, right? If they say, oh, I have no idea, I've never talked to a builder, I don't know anything, like who knows? Like they think they can build someplace for 300K, it really is going to cost 600K. They have no fucking idea. So you've got to push them towards that. But once they have a builder, then you're basically making sure that the builder's registered with VA if it's a VA deal, and you're sending them their registration packet. That's the first thing you do. You can't give the borrower any numbers before that, because the good thing about NCF is they're going to work up all the numbers for you. Like the form that we submit to them is so painfully simple. I have an example here. So this is once we get the builder registered, which means they're going to look at, their insurance, their licensing, their P&Ls, their balance sheets, history. There's like this business narrative form that they fill out, and they talk about their business and what's important to them and their experience and blah, 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 right? So NCF takes the responsibility of working all that out if that builder's viable and if they're going to register them. And this is all we have to submit to NCF to get all of those numbers once that builder is registered. So that's got to be the first step. You get the builder registered, then you're ready to move forward. So you're basically like putting some numbers in here that are super simple. If it's going to be site built, usually it's all here in the base home price. If the builder is supplying the land and the whole build, like it doesn't matter how this is separated out, it's all going to be a total, which is the most important thing. And then, obviously this is an older FHA deal if you look at the interest rate and the MI factor, but you fill in some general stuff about the financing piece, right? This is super simple to fill out. And then NCF gets this, takes them about 2 days, and they grind it back, and they're going to send you these big itemized forms back. And the flow through on these forms, one, they're super informative. It takes you a minute to go through them yourself and understand how it flows, but it all makes sense when you take time to look at it. So the biggest thing is and you're also submitting to NCF who title is, right? Because they're going to call title, make sure title's cool with doing the draws, with insuring it. And then they pull in their fees, So when you look at these worksheets from an LE standpoint, here's all your closing costs, right? Just how we're used to looking at them. And then you're looking at, here's your explanation of the builder's financing soft costs, right? So this administration fee to NCF's 2%. They say 1.25% goes to them, 0.75% goes to their fees and acquiring funding for the construction draws. So that's what makes these loans a little bit more simple on the one-time close, is that NCF is funding the builder's draws. And they're doing that through private money. So it's not Mutual that's doing that. Mutual's rate and loan doesn't really start until after construction's complete. So you get back these soft costs, then they do an estimate on what construction interest is going to cost on the deal. And then you can see on their worksheet, they're rolling all that in, right? So you got your 250 on the build. They're rolling all the construction or the closing costs into the deal, the soft costs that we just looked at, the estimated interest during construction, and that gets all finalized down here. This land acquisition is separate, so you can see the total acquisition cost where it went. And then, and so essentially your hope is that now you're going to only have 3.5% due at close. So in the way that this deal worked out, this FHA deal, that's basically a 250 build with a 50K lot. This borrower is only bringing $11,700 to close.
As long
John,
as long as it appraises, correct?
As long as it appraises.
can I add something in?
Yeah.
Just, you need this, because I'm doing one right now, in the process of starting one. You want this NCF funding sheet. You need this to set up the 1003 properly. Like Morgan kind of needs this sheet. So if you're trying to run AUS and get all the numbers in there, if you're trying to do that on the 1003 prior to getting this sheet, it's going to be inaccurate. So it's just really important. Like your very, very first step needs to get this this NCF worksheet filled out and back, because this is what Morgan uses to set up the 1003.
Yeah. Yeah.
It'd be great to get something that says step 1, step 2. Just piggybacking
Yeah.
off what you just said, Glorsa.
Yeah. This is step 1. This and the builder registration. That's step 1. They're kind of simultaneous, step 1 and 2. You really can't do anything else until these two things are completed.
Yeah.
Lauracell, are you good with publisher?
Sort of.
On my right side computer that I have to plug in, I always, when I'm doing anything, I have the basics of processing, the basics of loan, like the basics of a refinance. And I always take a legal piece of paper, turn it on its side, landscape, and then I start putting circles like in the upper left going, okay, here's where we start. So I'm hiring you to take charge of that. And we're going to have the basics of construction permanent financing on a flow chart by Gloracell and April. April, you're her assistant on this.
I think you need John.
That's
John's.
good.
Oh no, John's going to be the boss, and he's just going to oversee it. But you guys are going to work for John on this. I'm
Yeah.
teasing. All right, but
Okay.
maybe in the back of our mind, we do create a visual because loan officers. I
We
figured
need
this out.
visuals.
A lot of us learn in pictures.
Yeah.
Go.
So my point in throwing all this on the screen, which is kind of complicated, is that this is all you've got to do. And you get these numbers from the builder, right? Because the builder's not thinking about all this other stuff they're rolling in to the deal. Because at the end of the day, for any of these government loans, it has to be a non-cost plus contract. It's got to be a fixed. So we're going to end up working with the builder to redo their contract after this, right? Because we've got these additional numbers we're working into that fixed price contract. So when you start, the numbers that you need from the builder are very basic. You've got to know how long it's going to take them. If it's going to be longer than 12 months, we can't do it. We're looking for somebody that wants to finish in 9 or 10. And the borrower cannot be responsible for the interest-only payments because the idea is that's accountability for the builder. If the builder says they're going to get it in 9 months and we do all the calculations based on what the interest payments are going to be and that's all rolled in, and that builder drags his feet for 2 more months, he's taking it on the chin in interest-only payments. He's losing money every month. And that's how NCF wants it.
Hey, have you seen, John, that the builders in this price point, let's say sub 1 million or up to FHA,
Yeah.
are you seeing that the builders are taking less than a year, and how amenable are they to a fixed cost contract?
So I think that's the hard part, right? And getting a stable of builders that are willing to work in different price points.
Mm-hmm.
That it's like pointing a borrower to the right place to find them is tough because if they just throw it in Google, they're going to get a bunch of advertising BS,
Yeah.
So I think a good place to start is the local home builders association is what I'm hearing from a lot of people that are tapped in.
Yeah.
Even for a borrower, if they're, super into this, to go into a couple meetings, they can network pretty quickly and meet a ton of builders that are in good
Yeah.
standing, that are reputable.
I found this recently in Nashville. We're quote booming, but these builders don't have much business.
No, that's what I'm hearing.
And the subs don't either. So like a house being built, a 2,500 square foot house that has an architectural design that's not nuts, and let's just say decent grade finishing with nothing crazy, should take a good builder 6 months start to finish right now. Based on the fact that you have tons of subcontractors that are no longer holding them hostage because the work is not out there.
Yeah.
And I say this because I'm building 3 houses right now, and the third one we're building, dude, like it's going at warp speed, and it's a 3,000 square foot house. A month and a half in, it's under roof, windows on. They're going to start electrical and plumbing next week. And, I think this house is going to be built in 4.5 to 5 months. And I'm used to a 1 year turn time with these guys, which I'm talking 1 year on a standard house. Hell, anything that was like pseudo custom. And we know this, Michael, when we left Atlantic Union Bank, every 1 year loan we did, they were getting extensions. It was taking some of these customs 2 years to 24 to 36 or to 30 months on some of them.
Hey,
Yep.
Brendan,
Yeah.
according to NCF, if the builder is expected to take longer than 9 months, that they do that on a case by case basis. They expect it to be 9 months or less.
Yeah, and I
Mhm.
think that's the way it should be right now in most markets, unless someone has a market that just, it was all about labor and it was all about everybody holding each other hostage after COVID or during COVID with all that stuff. But I think it's washed out. And now the builders every builder that I talk to is hungry. Whether they're doing anything about it, they're either trying to sell their final little houses or they're hungry. One or the other.
Mhm.
And
So I
John,
mean, this is all relevant to turn times and how fast this stuff should happen for all of you listening.
And then John also too, like if the house appraises, there's really no out-of-pocket funding for the builder, right?
No. Mm-mm.
Right. I mean, that's the
And a
key.
lot of builders, when you're trying to network too, some of them are hesitant to to want to do fixed price contracts. But what you can rebut with immediately is they can build contingencies into their fixed price contract. That money can be there. I mean, there are some limitations, but they can cover themselves pretty substantially with that. And then once it's completed, if there's money left in that contingency, that just goes into the borrower's principal pay down.
Right. Do they have
Do
any?
you have an example? Do you have an example of that?
No, I don't have anything in writing that's an example, but we have those on several government loans right now. And what you can do if you're serious about it, if you take a look at this guy's signature, I don't know if Benton wants to take a grab, but this guy Travis is very available. He's the guy that runs the whole show over there. He also owns a construction company. He's very knowledgeable. He can talk to your builders, like if you're networking and they're curious and want to know more about working with NCF on these government loans, he'll set meetings and help you close those relationships. And he'll talk to them about all that stuff.
Wonder how many other companies work with NCF in the back end.
Travis said that if you made a list of every single lender that's offering government CP, he either has them as a current client right now or he's had them as a client previously, and he'll probably have them again. He said it's that small of a community.
Yeah, it's definitely. I think this. I think that what you said first, John, was watch the 2-hour video, and you'll learn a shit ton.
Yeah, it's pretty in depth. It's pretty good.
I think secondly, what Gloricel said is don't do shit until you have that back, because it's not, all your numbers are going to be wrong. And you said it too, John.
Yes.
I think whatever other technical stuff you're going to go through, if we did some type of Atlanta, Nashville, here's the basics of the government construction, and we printed it and made Benton make it pretty so that we could all like play with it and look at it. Because as much as we can learn right now, the ultimate is, okay, are we calling on builders to go solicit them? We better know our shit. Are we starting to trip into deals, and then all of a sudden, and this is how my business was built, is I did them myself. Then I realized I could broker the construction loan to local banks and do the permanent. And when I started in the business, John, I was at a bank in 1995, 96 that was based out of Richmond called Signet Bank. And my very first walk-in client in 1996 was a construction perm deal. So I kind of tripped my way into, oh, here's how it works, right? So I've always liked it, but my struggle is this, and this is for every one of you to think about. It's exciting, it's cool. The pool is much smaller, therefore the competition is smaller. These loans are harder. Don't kid yourself. They are harder. And like John said, foot and mouth and, ooh, I said this, but this is happening. That happens. Lastly, how do we start to generate leads, with our consumers and with our referring sources, maybe outside of the builder community? Because if you're going to go call, I have a tenant right now that works for Build Nashville. He's like one of their operations head. It's like a construction to perm thing it's like a franchise, and they do infill construction. Like hell, I want to call on the owners of Build Nashville right now. Because you know what I mean? Like you got to know what you're doing. Otherwise, these loans it's like, John, it becomes a sidetrack and it looks like a cool column on your flow chart for your marketing flow chart to generate business. But it can become a monster, like, Michael, help me out here. It can become like a monster sidetrack versus just like, hey man, what if we just did regular business.
I don't know. I don't know if I necessarily agree the way this is set up, Brendan. I mean, it's really kind of passed the buck for us as originators, which is nice, right? It's like
Okay.
you fill out this simple
by the
form,
way,
you get all these complicated numbers.
coachable. I'm always
You get all
trainable.
these complicated numbers, and then you've got a corporate processor that's putting these all in, and you're basically telling your borrower, like, let's cross our finger it appraises. I mean,
Yeah.
and then you get
That's
your
kind of
new.
it. Yeah.
I
You
think
just want to
that's
make
the
sure you
biggest
don't,
thing.
you want to make sure you do not have a, like the first step is getting this NCF calculation worksheet, and do not get a contract until the builder is registered and this worksheet is completed. That's
Yes.
the biggest thing. If you come in with a contract and then you start doing this worksheet and then you get it's going to blow up in your face. So have that conversation with the borrower. Like he said, scroll back up, John.
To this?
Yeah, this is all you fill out, like their information, and then the base home price is based on, what the builder thinks is the site value plus the cost of the build, right? So I have one right now where they own the land, 95,000, and the build is going to be around, I think, 650, something like that. And so essentially that's the whole base home sales price, and then they're going to give them the land cost because they've owned it for more than 6 months. So that's the other thing. If they already own the land and they've owned it for more than 6 months, then you can put that in that land cost, in the
Like
payoff.
the value of the land.
Yes.
Got it.
Yes. Yeah. So mine, like, he owns the land, it's 95,000. The build was like 595. So we did the base home sale price at 605.
Got it.
Because I
And
wanted
then
to
they're going to
go-
give him 95 for the payoff. So essentially the land is 95, the build is like 510. So the total is 605. And then they're doing the payoff at 95. So that's really all you fill out. And then you send this, and then all the numbers get plugged in by NCF, and then Morgan at corporate plugs in all those numbers into the 1003. And to John's point, you kind of just stand back and say, I hope it appraises. But all the numbers wise, they kind of complete for you.
Where do you plug that 12% that John was talking about in this?
That's
that
when you're
estimate?
doing a pre-approval. So for example, this client, mine, owned the land for 95. The build was like, 510. So he wanted to get approved for 605. So when I did a pre-approval, I approved him for like 680.
Okay.
Like I did his
That-
credit
that's
income
right.
assets for a 680 purchase price with, essentially 3.5 down, right? An FHA. And then, and ran AUS just to make sure that he could qualify for that price point. So you just bump it up a little bit when you do the initial, like, pre-qualification.
Okay.
Marcel, how'd you get the lead?
He came from one of my realtors that just he's a friend of a friend that wanted to build.
And the realtor said, do you have a construction loan?
Yep.
And you said, yeah, I do.
Yep.
You said, I have a great construction guinea pig product that I want to try on your client.
Yeah. Well, I had just set up a VA construction to Perm, and I felt like this one was less stressful. So
There you go.
So I felt a little bit more confident.
Realtor referred. You didn't really market it. She called and asked, which, by the way, it happens a lot.
Yep.
Yes.
Perfect.
Yep.
John,
Yeah.
other final thoughts?
I mean, that's really it. But in terms of your steps and getting started, I think another common question is like the rate and the pricing and how that works. And that's one of the things I like about this product conceptually, is that we don't have competition on it.
Mhm.
So from a couple standpoints, nobody's doing these. If you're quoting somebody an 8% rate or an 8.5% rate, have fun, go shop it. Call me back next week. And so when you quote the rate, it's going to be a point above what you lock it at, what you can lock it at. So if you're looking at your VA rates, you'd go a point higher. But the way that it works for the borrower when you're talking to them about rate is you
John,
just tell
a
them
point or 1%?
1%. I'm sorry.
Okay.
1% higher. So, if you're going to lock somebody at 8% for their VA construction loan right now, let's say, you just tell them it's not time to talk about your rate right now anyway. because you're insulated from market changes right now. And they said, well, what does that mean? When your home is completed, they're going to float you down to 1/8 above what the market rate's at. So if rates come down into the fives, and your market rate that's available would be 5.5%, you'd be 1/8 above that. There's no charge for that. That's just where they set you when your construction is completed. Now the other side of that, that's why we go a point above when we lock them, because that's insulation for us. If the market worsens, we're whole, right?
It
When we go
can't
to sell,
get, it
because we
can't
can't
get,
sell this loan until construction's done.
but the rate cannot get worse than 1% above where
That's
it's where
right.
we locked it, essentially.
Where we locked it, it can't get worse than that. It can only get better.
Right.
And when you say NCF kind of does all this, we're locking it through Encompass on our rate sheet.
Yeah, we're buying the securities, we're locking it, we're taking that cost. The NCF isn't handling that. Like, we submit the whole credit package to our underwriter once we get these calculations back, right?
Got it.
So we lock it, we manage it. After we're done underwriting it and it's approved, then we send it to NCF and they underwrite it again.
And also you want a long lock, do like a 55-day lock.
Yeah, long
Wait,
lock.
Don't be
so-
doing a 25-day lock on these.
Did anybody just hear that?
Yep.
Not the 55-day lock. They underwrite it again.
Yeah.
So what's that look like?
Their underwriting process is a little bit different because they're using private money. So they're making calculations. If this builder says, I'm going to get this done in 9 months, they're going to figure out with their 5-draw schedule, right? Where they're at, because they're paying about 10.25% for their money right now that they're using to fund these draws. So that's more so what they're underwriting based on, because it's NCF's responsibility to acquire the funds, to fund the draws, and to pay those lenders.
Mm-hmm. I
Say
think
that
another,
again. Say that again.
It's NCF's responsibility to fund the in construction draws, the financing costs for that.
Okay.
So that's what they're underwriting.
And if they're borrowing at a rate of 10, but we've locked the client at no worse than 8, what's the interest accruing during the construction, the initial draw to cover the lot?
So that's one of the numbers you'll get back once you give NCF everything. They're going to tell you what the estimated construction interest is for the entire project. That's going to be included in the total acquisition cost. So that's going to be financed, essentially. The builder's going to pay for that, right? I mean, depends how you look at it. If you're buying a spec home with a price tag on it, all these costs are included in the price tag. Obviously, we all know that. This one you just see separated out a bit, right?
I'm just curious at what rate of interest do they calculate it? Because old school, hey, we've got a one-time close, during construction, it's prime plus a half. And then when we modify, it all happens at once and your final, so the client would see prime plus a half and make an estimate. I'm just curious what rate of interest they're charging. Obviously, they come up with a calculation, but I'm curious what that is. Some clients might ask.
Yeah.
Like, hey, what interest am I paying during construction? If our answer is, oh, it's just all lump sum and here it is, 29,000, a discerning client might say, how did you come up with that number?
Yeah. Well, we can ask that question and get an answer.
Sounds like
back.
that guy Tyler. You said what's his name? Taylor.
Travis.
He could answer that maybe.
Yeah. He absolutely can. He knows the answer to everything.
Okay, cool.
I think another thing that we need to be aware of is what the FHA max loan limit is per your area. Because I was working with a client in Florida, and he wanted to take a $600,000 deal, not do the conventional, pursue FHA, but then that exceeded our normal loan limit. It was like 498 was their max, and ours here was like 670 or something like that.
Mm-hmm.
Yeah, that's obviously a big one.
which Rob and Andy and Aaron, that could be one of our advantages here in
Yeah.
Nashville.
Huge.
Mhm.
Yeah, ours is 942.
That's
Wow.
insane. Dude, that's
It's-
insane.
That is
For an
That's
super insane.
FHA,
for an FHA.
I am shook.
Yeah, I have a client right now that we refinanced his house that was on FHA because he wants to keep it. And I have to do an estimate this morning because he wants to go up to 1.2 million. And his credit always hovers around a 680 to 690. And it's like if you price out high cost conforming it's the same limit, 940 something or
Hmm.
versus FHA at a 680, it's like it's like 3 points cheaper on an FHA, like charge wise, and maybe 3 points
Yeah.
cheaper and a quarter to a 0.5% better.
Mm-hmm.
Mm.
And mortgage insurance, way different.
Yeah, I mean, what's the calculation for? I mean, he's going to be putting down 20% or more. He'll still have to pay it, but I don't know. What's MI's lower?
50.
Yeah, 50 bips. So yeah, I mean, maybe the rate washes out, but the price is still. Point
Yeah.
being is that on these construction loans, depending on your market, like April said, definitely go to the FHA county limit wherever someone's mentioning they own property and look it up like right away.
Yeah.
To
I think,
avoid that.
well, and
Yep.
we're doing, like I said, we're doing a VA one now where we just sent the builder packet and information for them to complete. So we'll let everybody know how this process goes through the, underwriting and whatnot, all the way through closing and see how smooth it is. But I do think if it is smooth, it is, I think the end game here is find the builders who do not want to build spec, because who does? It's risk. And then that's your funnel of leads from the builder. You do a few of these or one or two with the builder and they like the process. That's where I think your leads come from, is those builders. And then you
That's
keep,
why that's so attractive to them, because of cash flow.
Yeah, and hedging the risk.
when
instead
they're
of
already
that.
registered, so we know that they're going to, unless something
Well-
goes south with the builder, they're going to keep getting
Well, know
approved
this.
to do
They're
this.
attracted to cash flow, but remember, John, if they have a line of credit and they call their creditor for the draw to pay their subs and their own employees, they're in control.
Yep.
Their biggest problem with trying something new is like, who do I call when my framers are done? Because they want to get paid on Friday and they finished on Wednesday.
Yeah.
And I think that's where, when you say cash flow, understand this doesn't solve their cash flow problem initially if they don't know what they can control or how the money gets paid. And that's critical to understand, that like until you experience it, you're not solving their problem yet. Does that make sense?
It
Unless
does
they-
to an extent, but they're not spending money on obtaining the financing for it, right?
Well,
And
I mean,
They still
if-
got to make sure their people are getting paid on time.
yeah, I mean,
to keep good
listen,
people.
if they're a builder that's worth a shit, they've been around the block a couple times and they've had their own lines of credit.
Mhm.
And this, John, is appealing because they're not using their line of credit. Also, remember this: as soon as this closes, it's not their property anymore.
Mhm.
It's the borrower's.
That's right.
So one of the liabilities, that underlying liability now switches to them, from them to the client, but they still have the contract and they want to get paid and finish the job. So yes, a capital infusion, it helps, but I just know that their biggest objection about cash flow is like, we do not want to work with a new lender to where we start this process and all of a sudden we're begging for money and there's some inspector that takes forever, and now we're 2 weeks behind on payroll because the job at lot 31 for the veteran, that $2 million deal, whoever that lender is sucks at getting us paid.
Hmm.
And they know they'll They know because then they can't pay their subs. So
It'd be
this,
good if we could check references on that, like a couple of deals that they've closed
sure.
NCF to see,
Mhm.
hey, how has that process worked? You know, with someone that has closed a deal, has started the construction.
Yeah.
You know, I think that would, because I would like to know that, because those are like number one questions builders ask is how
Yeah.
is the payout? Hey, do I get any money at the closing table to start these people's project? It's not my
Yeah.
house, it's their house. So I
Yeah.
think those are very viable questions that we need to see what the response is from Travis. Do they have some references, you know?
Good
Yeah.
point.
John,
We're gonna
John, do you have a
Logan,
max VA? Do you have a max VA loan amount?
2.5.
2.5. Okay, thank you.
Logan, you had a question?
hey Logan, in Boca it's 3.7.
3.7. Oh, maybe not enough.
Which is crazy. You're doing 100% financing on a $2 million house.
Yeah, it's wild.
Uh-huh.
Well, and remember that's going to be a veteran that, veteran
A
loans.
colonel.
Well,
Business
remember
owner.
this. That profile is probably a retired veteran who's getting military retirement play. Also, probably was a really good saver. They're never coming in with 100% financing. They've got money.
Right.
Mhm.
They're that's like the sharp ex-military, and they probably have some other business they ran once they got out of the military. At least
There you
that's
go.
the
Yeah,
profile. Yeah.
we helped a guy in Virginia back in like November. He went 0% down on like 2 million. He was the head of the Atlantic Fleet for the U.S. Navy. He went 0 on 2 million. It's pretty impressive.
Yeah. Well, the John, any other parting thoughts? It's 9:15.
I
No.
got one quick question before John jumps in. John, on that scenario you put up where it said total cost 335 on that far right side, is
Yeah.
that the amount that the home has to appraise for, the 335?
Yeah, that's what you're looking for there.
Okay.
One other caveat with that's specific to VA is that when they do the appraisal, it doesn't differentiate the land and the build. So for FHA conventional, they say, oh, the land is 100,000 and the build is 500, so it's a total of six. Like when they do the VA appraisal, they just appraise the whole thing, including the land, and they don't really differentiate what portion is the land and what portion is the build. So just keep that in mind so you can kind of explain that to the borrower.
That's good to know.
Yeah,
Has anybody
especially if they
does
already own the
anybody have a
land.
sample? Does anybody have a sample of a VA appraisal that I'd love to see what that looks like to kind of, because that would help for sure, just understanding what the actual form looks like from the VA versus a conventional appraisal. Because conventional, they clearly mark out, hey, here's what I'm valuing the land at.
Yeah.
And here's my final future value is X, but here is land value. And I mean, we used to look at that all the time.
Clarissa,
they-
did you get one done on
I'm
Fight?
looking because Fight had one, the appraisal done. I'm trying to see if I can find it in Encompass. So that was it, and they owned the land. So you kind of have to explain, like, theirs was like 1.4 million. I think they
Yeah.
bought the land for, I don't know, 185 or 200, something like that. But the
Like-
1.4 million is including the land. So
Yeah.
the VA, and Morgan says that she always requests for the appraiser to, separate it, and she's yet to have one single VA appraiser do it.
Well, let's
So-
see if you have that sample. We could look at it and just see how, like, where
Yeah, I'm gonna see if I can find it in my.
is there any commentary. All right. Well, John,
Mhm.
the only other thing I would say, like, for this call, this is like kind of that, the loan officer roadmap to success.
Mm-hmm.
Like, this is somewhere in that, this isn't on the basic green line. This is somewhere in like the advanced niche selling department.
Yeah.
And I think that, like, learning how to close an infill builder, learning how to approach conversations with, honestly, maybe other small banks that just don't even like construction loans right now.
That's true
You know,
too. Yeah.
That's true.
Yeah, like
Mhm.
I get leads from now Mary Benny Wilson, my lady in 2001, who said add 10%. She's retired, but I have another lady. I have two other ladies that I know, and there's bankers everywhere, just like what John said. Not many people do this. And when they think about it, it gives them headache because they either tried one and it blew up in their face, or they're just like, I stay in my lane. Like, I'm good at this.
Yeah.
So I want to hear more, John, as this year progresses, because you've impressed me that this is like something you want to do. And I love that like you're piloting it and that Gloracell's got one and April's doing, everybody's kind of fishing around in this bowl. Who really wants to take it and add it as a column that like they make a huge dent in their business and production.
Yeah.
It's like the law of attraction. You get 3 going and then all of a sudden you got 10 going.
Yeah.
Travis
Well, and I think
said,
you're a referral. I think, if you're successful and they go smoothly, I
Yeah.
think you'll have referrals come out of the woodwork because
Yeah.
people
Yes.
talk, builders talk, banks talk, what I mean?
Yeah,
Travis
hey, I
said
got
that
you.
he has originators that he works with that at any given time he's working on 8 calculation sheets for them. Like
Wow.
they're so tapped into the building community and they network so hard, they are getting referrals constantly. And some of them don't work out, right? But and he said the other thing of that is our VA product is so unique with being willing to go 0 down up to 2.5. I mean, potentially you could have a close on a new build that's 0 down, that's 0 at close, if the numbers work out right, the appraisal works out right. And a lot of those that work out, they already own the land free and clear, so it's got built-in equity. But
Hey,
you know,
Michael.
a lot of those leads that you take end up not doing construction, and you've got a builder that just sent you a VA client and you had good conversations with them and they just end up buying a resale with you.
Yeah,
Hey, Michael.
true. Good point.
When John and Michael and
Yeah.
everybody in Atlanta and Nashville, or anybody else, when Michael, when you and I wrote that construction perm, like we wrote it as if it was like a short story book.
Yeah.
Maybe we get Benton to get the document back out to everyone. John, you scrub it. And we kind of, what we could do, and again, this is just a marketing piece for clients, because I have a feeling that if it grows and John, you get a lead and some guy leaves you an email and says, hey, I'm thinking about this, and you're busy and you're trying to connect, I always like that. Hey, before we talk, it's Friday, I can talk Monday. I'm going to clip a little article that we wrote about construction to perm financing with jargon, process, timelines, things you need to know, versus one that was written by, the investor or the marketing department. Michael, we take the one we
Yeah.
wrote, maybe spend a couple hours playing around with it, and we call it the construction lending upfront things you need to read about. And John, it's enough for a client to, like, if they really want to read, that first phone call would be easier, or you have the first phone call and you send it as a supplemental thing that they can read through. Because
Yeah.
otherwise we catch ourselves doing these presentations and it's like, oh shit, what did we miss?
No, I think it'd be great. Just here you go. I'm going to email you this document, this guide. Here you go. Read it and let me know what you think. Call me back, or I'll call you next week. Just get,
Yeah.
Yeah, and then you know how serious someone is when they read the 10 pages and have good questions.
saves you 30 minutes on the call.
Hey, Brendan,
Hey.
I found that VA appraisal. So what they did is they valued it above the contract price, I guess, to make up kind of the difference for the lot. Because this
But
one had a contract price of 1.2 and the lot was worth around 160,200 and they appraised it at 1.4.
And nowhere in the VA appraisal does it say site value or anything around the site.
No,
Huh.
it does make a note down here that says owners purchased the land on 4/28/2001 for 160,000 as part of an arm's length vacant land sale. So it's in the notes, but it's not in the actual,
Thing, yeah.
thing. So just
Cool.
And
little
do
different.
we have a turn time on this NCF financing so that if they say the builder says, well, what's the turn time from
Nope.
beginning to end.
Oh, I don't know, John, do you know?
What's the turn time for what exactly?
The start of the deal to the close of the deal. If we have our ducks in a row.
I mean, but potentially if you had a builder that needs to register with VA, once they get all their stuff in, that's a 5-day turn. They get us over the initial contract with numbers with specific quote on completion date. We submit that first simple form to NCF on a 48-hour turnaround, get back the specific numbers, input it into our 1003, probably have it in underwriting the next week, get a credit approval. You know what, 2 days after that, after we submit, assuming we've got all the docs that we need for our borrower, it's not very long. I mean, it just depends how
The issue
prepared
is
that
the builder. The
Okay.
builders are slow.
Okay.
Yeah.
I think let's do this. We're doing a deal now for sure, because he's quitting his job to get this deal. We'll let you know how it goes. We'll do it, every couple of weeks, we'll just, do an update, let everybody know. And John, take notes about how long this stuff takes.
Okay. Yeah, I
Cool.
came back to Mike and I'm like, Mike, he's gonna retire based on the fact that he's got to do that to get this loan. We're both like, fuck. Like,
Let's not mess it up. Let's not mess it up.
I
Yeah.
Well,
mean,
guys, this was a very technical, good call. There's a lot of follow up on this. I mean, this
Yeah.
is, if someone decides to get good at this, this is a $250,000 to $500,000 a year paycheck kind of.
Yep.
mix.
and
I mean,
want
it just is. But what I heard is I got to watch that video first.
it's
That's what I
really
heard.
good. Yeah, you gotta
Yeah,
watch
I
it.
heard I got to watch the video first, and then let's wait for John, Michael, Gloricel, April, whoever knows their shit. Let's get that 10-page thing that Michael and I took the time to co-write, and let's get some more authors on it so that
Yeah.
we can tweak it and go, hey, this is a pretty good, like, you could give it to a realtor, you could get,
Yeah.
you could walk into a community bank and say, hey, I've got this product and here's what I give to clients. If you have people walking in wanting to finance, custom homes on their land,
Yep.
send them my way. And then you put your picture on it, and
Let's do it.
we keep building on this, and maybe we turn this into once every 90 days on this call. It's our construction Friday, where we're going to talk about the development of the program and
Yeah.
who's made some huge inroads. And think of this like financial planners. We always want to come back to them, but it's realtors and past clients first, and then all the other niches after that.
That's right.
Awesome. Well, good
Cool.
stuff. Thanks,
Thanks,
John.
John.
I
Thanks,
love the
Florida.
confidence. All right, guys.
Awesome.
Bye.
Have a great weekend. See you guys.